All righty. Good morning, everybody. Good morning. Good morning. Happy Thanksgiving weekend. This is for educational purposes today. And this is an outline of kind of what I'll be going over. As I said, I have no idea how much I'm going to cover today, but whatever I don't, we'll cover in the next couple weeks or so. But some of the things, kind of how I look at an options portfolio, stock replacement, collars, give my thoughts on these things. I think a lot of people sometimes don't think about it enough. Is there alternatives that may be better, right? Like we'll talk about today, how many people do a collar? How many people do a collar? Any of you do collars? For those of you who don't know what a collar is, you're buying stock, then you're buying out of the money put and selling out of the money call. Right? And we'll talk about that today. Kind of what's been on my heart is, are there cheaper ways to do things, right? What are the pluses, what are the minuses, but, is there a cheaper way to do things? How many people knew that a call vertical debit spread is the same as a collar? Have any of you known that? That a call vertical debit spread is the same as a collar? Did anybody know that? This has been hidden from the world. You have to be on the west side of Chicago to find that out. I'm joking. But the key is, collar, what's on my mind always is, what's the cheapest way to do something, which would be the best yield? And call vertical debit spreads are much cheaper than collars. Why? You don't have to deal with that stock. Some other things, covered strangle. Now I'm going to talk a little bit about iron condors and butterflies in lieu of what's going on in the market, but let's jump in. So how I look at things, all of you, whatever trade you do in the options world or stock, whatever you do, I would put it into one of these three categories. So whatever you do, it would fit into one of these categories. And so I like to have some structure before I jump in. Where do things fit in? And if you can kind of get where they fit in, then you can kind of make a plan, right? And you can say how much, let's say I'm going to have a $100,000 options portfolio, or it could be $50,000, or it could be $10,000, whatever the number. But it could be a $100K options portfolio. Real quick, three parts of your portfolio where you would allocate dollars. And long portfolio strategies are starting under the premise that of a long-term investor. And a long-term investor, what's their statement of philosophy of your trading? It's saying, I think the market is going up over time. I think a stock is going up over time. It's the investor approach. That's the long portfolio strategy. So you're basically taking this approach that these strategies are going to be more neutral to bullish, because you're saying, hey, over time, I want to lean long. And so that might be, I'm just throwing these numbers out there, 30% of your portfolio. And on this portfolio, let's say you might put $20K in cash for adjustments, opportunities, different things that come up. So you have 80 left to play with. And so in this part of the portfolio would be long stock, long mutual funds or ETFs, long leaps, cash secured puts, put credit spreads, long diagonals, which are covered rights, where you're buying an in-the-money call as opposed to stock. And again, anytime you use stock, it eats up a lot of capital. And then in this category, which is basically neutral to bullish, I just put one type of income portfolio strategy, this out-of-the-money broken wing butterfly, which is basically a bullish strategy, neutral to bullish. So out of this $100,000, I might put $30K in here. And then in the income portfolio, you know, I'll just put for numbers here, I might put, well, again, this all depends on the person, but I might put $30K in income portfolio, right? Again, we're starting with 100, 20K would go in cash, so we're dealing with 80. And so if we're dealing with 80 in this hypothetical example, it would be 30, 30, and 20 in spec. And some people may do less. I may do less. But income would be, the philosophy of the income portfolio is I'm going to take advantage of probabilities and decay and play these range-bound trades, basically, and rely on good risk management to bring in weekly or monthly income. So these would be strategies I'd be doing all the time. These would be strategies that I would, especially the option strategies, would be doing every month. These strategies would be done every month, every week. Iron condors, butterflies, calendars, double diagonals, longer and shorter duration. Short duration to me is 7 to 15-day trades. Long duration would be 30 to 60 days. But these are more, the philosophy here is more based on probabilities and decay, and I start them pretty neutral. These are more neutral to bullish. And then speculative portfolio are going to be, whereas the long portfolio, you're taking the view of an investor, bullish over time. The income portfolio is taking probabilities and decay. This is for monthly and weekly income. Even though the long portfolio is trying to make monthly and weekly income, but there's a bias on the direction. Speculative, the whole basis of that is I have an opinion, right? Based on a chart, based on a late night of pizza, based on fundamentals, based on political conditions, whatever, however you come up with an opinion. Fibonacci, Gubernacci, Harbin, whatever you come up with, right? Whatever you come up with. But speculative portfolio strategies would be buying long options and long verticals, debit spreads, long straddles and strangles, directional calendars and butterflies, strategies around company earnings, more to make money if it moves. All right, so any questions on, let me ask you a question. Do any of you have any strategy that you do or any strategy that you've dreamed of that doesn't fit in one of these three? Yes or no? Does anybody here have a strategy that doesn't fit in one of these three categories? Wayne says a risk reversal. Wayne, are you talking about like buying a put, selling a call? How would you define? So I'm asking, is there any strategy that you guys do that wouldn't fit in one of these three parts of the portfolio? And Wayne said risk reversal. Or Wayne, were you just telling me what you do? Francois says ratio spreads. Would ratio spreads fit in here? Of course they would, right? I mean, what do you, again, once I find out what they mean, Francois, are you just saying buying one, selling two, or buying two, selling one? Are you doing that against stock or just separate? Buying one, selling two calls, or, yeah, if you buy two, sell one, that would go under speculative part of the portfolio. If you buy one, sell two, it would be more It could be directional or income, but they would fall in one of these. Wayne says his risk reversal is sell a call credit spread to finance a call debit spread. Sell a call credit spread for income to finance a call debit spread. So that would be kind of directional, because if he's financing a call debit spread, he's thinking this is going to go up, right? But he doesn't think it's going to go up too far, right? So maybe he's going to sell a call credit spread out of the money. But the bottom line is, if we could define what you guys do, everything you do is going to fit in something here, right? Either you're taking the long-term investor approach, income based on probabilities of decay, you don't think it'll go up far enough, or speculative. Now, so let's get into some strategies, and I'm just using Apple as an example here. Apple actually closed at 172.29. But I'm going to jump around here a little bit. I'll just throw this out here for you. I'm going to jump around. Here's a list. I was just looking at this. Just to give you, and we'll have these slides available for you, but what I did is I put together a couple slides, stocks mostly over 150 and stocks mostly under 150, and I took the stocks that have the most liquidity, meaning they trade lots of options. And then what I put on there is this. The ones in red are the ones that, if you look at the price chart right now, you'll think, wow, the market's really going well. It's going up. In other words, the ones in black, right, these are your most liquid stocks, over $150. And these are stocks I would look for. Some of these over 150, this is from stocks. This is where I might get some candidates for credit spreads or iron condors or something. But in red will be stocks that have actually pretty good looking price charts. In other words, if you look at price charts of Apple and Amazon, do they look good? Yes or no? If you look at Apple and Amazon and Baba and Facebook and Google, do those charts look beautiful? No, they look horrible. But, so in the midst of this correction, RUT's down 14%. SPX is down 10% as of today from their highs. The ones in red are actually charts that look good, right? So that gives you an idea of stocks that, and why am I giving you this list? Isn't it nice to know, even in this market, what are some stocks that aren't paying attention that much to what's going on in the market? Wouldn't that be a help? What are some stocks that seem to not be that concerned about what's going on in the market? So you can look at these stocks in red. All of the charts look pretty stinking good, right? In other words, you look at these charts and you won't. They look really good for the most part. And then here, stocks under 150. Now, this list, I think I took it a couple months ago. Since we've come down, some of these stocks have come down a bit. But overall, this would be a pretty good list. And then here's a list of stocks that, if you look at their price chart under 150, they look pretty good, right? The ones in black, hey, look like something has happened in the market, right? They've gone down a bit. I'm not saying they're horrible looking, but the ones in red, you look at their price chart, it looks relatively good. Anyways, something to look at. And again, I think when you're, another key reason I gave you this list is when you're looking at stocks, it's real important to have good liquidity option, be able to get in and get out. Michelle Salazar has a question, says, do you mostly trade SPX for the income portfolio or a mix with stock options? Just wondering how they compare risk-wise. I will do mostly in the income portfolio. In this part of the portfolio, in the income part of the portfolio, I will do mostly, I would say 80% SPX and some RUD in this part of the portfolio. In this part of the portfolio, I might do 30% SPX and 70% stocks. All right? And this part of the portfolio, maybe 50% stocks, 50% indexes, or something like that. But here I'm using, for this part of the portfolio, mainly well-diversified, lower volatility indexes, Russell, which is made up of 2,000 stocks, SPX 500, and they're much lower volatility than a lot of the crazy stocks. Petru says, which SPX butterfly is better, 100 wide or 200 wide? For those of you who know me by now, there is no such thing as better, right? There's pluses and minuses, but there's not better. I'll answer this quickly because I want to get on with other stuff, but 100 wide butterfly is fine. 200 wide butterfly is fine, but it costs a lot more money. And so there's pluses and minuses depending on capital. Always capital is a consideration when people are saying best. Well, you also, the bottom line is yield and how much capital you're putting up is important. And usually volatility is a consideration. And in butterflies, capital is you put up when option volatilities are a little more higher like they are now. You'd like to be wider, but you take more risk. Anyways, but we'll talk about that. Kenneth says, how does the performance of each of the portfolios compare? Well, I mean, as you can, the income portfolio is going to be based on the individual that, if the probabilities in decay over time are always going to do pretty good, right? So for the income portfolio, the performance in that is going to be, are you disciplined? You're putting these on every week. Are you going to keep are you going to adjust when you're supposed to? It's more based on that. Long portfolio also, but long portfolio is going to be based on what? What's long portfolio going to be based on? Ultimately, the success of a long portfolio. Think about what it is. What's the long portfolio? I promise that's not a trick question. The market going up, right? So 2017, 2016, 2015, could a blind squirrel on roller skates, right, have made money covered rights and options or cash secured puts or credit spreads? Would they think they discovered gold? Yes. Why? Market just went up. This has been more challenging. All right, so let's jump into a few strategies. So let's go. One thing that's popped out in my mind is I think. So let's make an assumption that you're long stock. I just took this example in Apple, and I used the price of $173.74. It's actually, this price is a little bit, I took this slide yesterday, but it's actually a little bit higher than Apple closed, even further down, near 172. So if you look at how many people right now who own stock, right? Let's talk psychology for a second. For those of you who are stock owners in your retirement account or whatever, how many of you are still concerned about the downside? Most are concerned. Okay. Would concerned also mean, hey, Dan, I would like more protection on the downside? So, with that being said, and again, I'm more addressing stock owners on this slide. At this point, right, on most stocks, if someone said to me, Dan, would you consider right now, with the SPX down 10%, Russell down 14%, the FANG stocks getting destroyed, a lot of other stocks down 10%, would you consider a collar strategy? And I'll get to that in a second, or a covered right? And my answer would be, today, at this point, I might go with a type of a covered right. And this is what I would go with more, if I was an Apple or something, maybe something like this. And again, I just took something over 30 days, and here's an example of a 42-day Apple in the money covered right. And let's talk about it. So one thing you notice is, if we're looking at Apple, let me get a price chart of Apple here. Can you guys see that? Obviously, you can see the stock off its highs of 233 is at 173, right? That's down a lot. So right now, Apple 233 minus 173 is $60. So Apple's 25% off its highs, which had hit around beginning of October. You guys with me? Apple's down 25% as of now. So, and again, let me just point this out psychologically. This is, if I ask most of you, what do you think of Apple here? And I'm using this as an example. That's it. Just because a lot of people look at Apple. It's the most liquid stock in the world, right? Trades the most options. By far, it's the most liquid stock out there. But what I'm saying is, psychology-wise, even if you like Apple, and I'm not saying I do, even if you liked Apple over the next year or two, you're still nervous as heck about it right now, right? And so with the stock down 25%, you also can see what happens when stocks go down fast. If you look at the implied volatility, option volatility measures the time premiums in Apple. They're high right now. This metric says about 36 cents. 36. So what does that mean? It just means there's more time premium in these options. So if you're a seller of options, you want to be selling that part of an option called extrinsic value or time premium, because that is fluff. That part's going to decay. And so right now, an opportunity from the world of covered rights, in the money covered rights are going to be more attractive for downside protection, and they can get you about 8% downside, right? So in other words, if you're a long stock owner, let's say Apple, I took this slide when Apple was on around 173.74. And because there's a lot more time premium in these options, and why is there more time premium in these options? Because these stocks are moving around more, so people are willing to pay more for these out-of-the-money calls and puts, and that's pumping up the time premium part of an option. So here's an example. Let's say you bought 100 shares of stock, or this particular example, at 173.74, right? And if I go sell, instead of typically in covered rights, somebody's selling an out-of-the-money call. But here we're selling an in-the-money call in Apple, about $8 in the money. And it's still $8 in the money. And it still has decent time premium. This is the value of the 165 calls, January 4, 165 calls. So just on this graph, for those of you who aren't familiar with Thinkorswim, the solid green line is your expiration graph in 42 days, how your P&L will look in 42 days. The purple line is your P&L the day I'm looking at this, the day you put it on, right? So you can see here, if I sell the 165 call at $13.55, how much of this is intrinsic value and how much is extrinsic value or time premium? So you just take the price of the underlying, 173.74, minus your strike price of 165, and you get $8.74, right? $8.74 of intrinsic value, right? $8.74 of intrinsic value, correct? The price of that option is 13.55. So if you take 13.55 minus 8.74, it leaves us with $4.81 of time premium, extrinsic value. And that's what volatility measures, that extrinsic value. So quite a bit of this price, $8.74, is intrinsic value. The rest is extrinsic value. And when option volatilities pump up, when these stocks move around more, like Apple has, you'll be able to do this strategy that in a low volatility environment doesn't look so good. But here, if you sell a 165 call, there's still, I think, plenty of time premium for a 42-day trade. And then if you look at this break even here, break even is where the expiration graph, this green graph, in 42 days crosses zero. It's like 160. So right now, with Apple already down 25%, this in-the-money covered right will give you another 8% downside protection for 42 days and still pretty good upside. Brian said that's about 3%, which for a covered right is pretty good. Usually covered rights, your potential yield will be about 1% on these things a month. So that's what I would be more looking at because of the high premium. It takes advantage of that versus a collar which doesn't take advantage of the high premium because you're buying an option. So in this market with the implied volatilities higher right now, I would favor maybe selling more in-the-money covered, right, taking advantage of that high premium versus something like a collar. Now, if you thought, now, here's the key. You could say, well, Dan, I'd rather do a collar because I'll get even more downside protection. But let me ask you a question. With Apple down 25% already, if you thought Apple was going to just tank a lot more than 10% over the next 41 days, doesn't there come a point where you say, why am I in this stock? Right? If you need to, at this point with the stock down 25%, if you want to go and you want to do a collar because you think it's going to drop another 20 or 25%, my question would be, what the heck are you doing in the stock, right? Remember, why do you do covered rights? Covered rights are in the long portfolio. You do them because, hey, I like this stock over time, right? Andy says, what about early assignments? How many people would be scared to get assigned on that in-the-money call, that would really bother them? How many people would be concerned about getting exercised on that call on the upside? How many would that bother to do this in the money covered right? How many people would be a little nervous selling a 165 call with Apple at 173.74, getting assigned on that? Well, let me ask you a question. Is it controllable? In other words, is it a mystery when you'll get assigned on those calls? No, I mean, again, here would be the plan. First of all, here's the expiration graph. Here's the graph today. I'll make a few comments on getting assigned on covered rights. Well, Lee says let's examine this comment. Lee says anytime an option is in the money, it could happen. How many agree with that statement? Yes or no? Technically, could you be assigned on a call anytime it's in the money? Could this Apple call be assigned anytime? I'll be honest with you, it could, right? It could. When I do this trade and I sell a call, the owner of that call, under the laws of the U.S. Constitution, can he exercise that call anytime he wants? In other words, if the owner of the call, if I sold that call today, if the market was open for $13.50, or I sold the call for $13.55, and if one of you, let's say Lee, was on the other side of that trade, if Lee exercised that call on me Monday, do you know what I would do? What do you think I would do? What do you think I would do if Lee exercised that call on me Monday? If I sold the call, or let's say Tuesday, and he exercised it, what do you think I would do? I would call Lee up, and I'd say, hey, Lee, next time you come to Chicago, you pick whatever steak restaurant you and your wife would like to go to. It's on me. And Lee, I'm going to check with the Options Clearing Corporation and see if you could be on the opposite side of all of my covered rights. Okay? And if they say yes, Lee, anytime you're in Chicago, we'll pay your hotel, we'll pay your food, we'll pay anything. Now, in my experience trading for 24 years on the floor of the CBOE, right? Lee's right. Anything can happen. If you're in San Francisco, there could be an earthquake today. Yes, there could, right? If you're in Chicago, which I am, highest murder rate in the U.S., you could be shot today. I agree. But let's talk a little bit reality. Reality. In the pit, can I count on one hand in 25 years that I've been assigned on a short call where there was a lot of premium like this and it wasn't a big dividend or something? No, yes, I can. Usually somebody would make a mistake, right? But did it happen a lot? No. Again, I'm talking 20-some years in the pit, maybe 3-4 times. Somebody just made a mistake, right? But again, what's the key? Always monitor when you're doing covered rights the time premium. And as a general guideline, write down what's the time premium of the option, the extrinsic value, right? I'm not saying the intrinsic value for this in-the-money covered right. Write down the extrinsic value, okay? And when the extrinsic value, in this case, it's $481, just as an alert, just so you're on top of your game. When the time premium decreases by 80%, you need to, in Lee's house, have bells and whistles go off, you get an alert hit you, but you want to watch that time premium. When the time premium decreases by 80%, there's two things my voice message to you would say. You ready? Two things. One, Lee, what are you still in the trade for? Because if you're in the money, right, you're in the money, you've made most of what you're going to make, you need to probably roll it out to a further duration if you still like the stock, right? And if your time premium's disappearing, that's when you're going to be at risk for getting assigned. So just monitor the time premium. Now, if there's a dividend, as Rick says, you're looking at the time premium, but you're looking at the amount of the dividend. So there's a few more things to look at. But in most cases, what I've found with people with covered rights on the upside, it's very manageable in terms of when you would get assigned and stuff if you're just watching the time premium. But again, remember, this type of discussion about concern about in-the-money covered rights, concerned about getting assigned is like saying, hey, I'm not going to play the lottery because I don't want to have to pay the taxes. Right? Isn't that crazy? If you're getting assigned on a short call, first of all, if you're getting assigned and you don't want to get assigned, there's a serious lack in your options knowledge. Let me say that again in Spanish and a little bit of Swahili. If you're getting assigned on your short calls, in most cases, if you're getting assigned on your short calls, right, and it's turning into short stock, and you're not happy with that, I'd say in 85% of the cases, would you agree, there's a lack of options knowledge about assignment. And I think it's more of an education thing. Now, again, why do I like an in-the-money covered right? How many people can see this? If in this environment with VIX at 21.5, and we just looked at the implied volatility in Apple is 36. For anybody trading Apple, 36, what it's basically saying is these are some of the highest time premium levels, volatility levels in Apple. And another way to say it would be this. Normally, if I was doing 4 months ago when Apple was at all-time highs, volatilities were lower, if I looked at a 42-day in-the-money covered right, would there be that much time premium in there? If 4 months ago when Apple was near all-time highs, volatilities were low, there'd be significantly less, maybe half the time premium. So I wouldn't be getting 8% downside protection. So this situation has arisen because what's going on in the market right now. Whereas real quick, so this is short Vega. So this is saying as the option volatility, as it goes, if that 32 volatility that we talked about, if Apple starts stabilizing and the volatilities will come down, that means you're going to be making some money off of these short calls. But you're going to benefit when the time premium starts reducing. Okay, this position also has positive theta. That means you're getting some positive theta every day from this short call. So this makes sense to me in this environment, whereas if you look at a strategy like this, here's a 42-day, a very similar Apple collar, same expiration, but a collar is simply, if the stock was at 174 when I took this slide yesterday, all right, against my long stock, I buy a 170 put, and these are 42-day options. On the downside, this is the expiration graph, to cap my downside, and on the upside, I'm selling an out-of-the-money call. So I still have some upside I can make before it levels off like an airplane at 35,000 feet. But when you look at this position, now I'm not really short Vega. This is minus 0.16, close to zero. My theta is close to zero. So these are these type of trades are more neutral, depending on how you set it up. There's more neutral theta, neutral Vega. I want to take advantage of the high volatility, right? I want to take advantage of it. And I think getting 8% in Apple is pretty good, right? Now, obviously, maybe we can address another time in terms of, I think somebody mentioned that, well, what if Apple goes down more than 8%? Well, I mean, we have a plan set up on the particular trade, right? On each, but I'm saying we're just talking about the setup today. Every trade still, we have a 4-step risk management plan on every trade. How do we set it up, which we're talking about here, profit target and max loss, when to adjust and how to adjust. But as you can see with a collar, if you look at this, this isn't going to do as well for the next $8 down. Do you agree? If you look at the Apple trade, the covered right, I mean, at expiration in 42 days, you're profitable, right? Between 159 and 173. Agree? You're profitable between 149 and 173 versus with this position, are you making money between 149 and 173? Yes or no? Are you making money for the next 8% down in Apple? No. No. So what if Apple goes down 30 more percent? Again, I challenge you. With Apple already down 25%, if you think the world's going to end, which is normal feelings when we're down like this, why are you in the stock? Right? If you think the world's going to end. But anyways, I'd rather have that 8% down, and then if I need to do something, I'd do something. I could buy a put. Then I could, if I want to turn into a collar, then I could do it. You agree? So what if Apple gets down 8%? Well, collar it then, but this whole area where I'm losing money with a collar, I could be making money with a covered right. Anyways, folks, this may turn into 3 Saturdays instead of 2. I think instead of going into something else, I will, if you have any questions on the little bit that I went over today, but I think it's important to think through these things. Think through these things, why you do what you do. And the other thing I want to challenge you with until we meet again would be, as you're going into 2019, do you have a plan? How many of you, yes or no, have a very succinct plan of how you're trying to make dollars every month, whether it's $1 or $10,000 a month, but at least you have a plan. I'm just talking a plan. Or so Dan, I trade now and going into 2019, I trade with a plan of how much I'm looking to make every month. Not that I always necessarily make it, but I have a plan. B, Dan, I trade by the seat of my pants. How many have a pretty succinct plan that they have? And how many, and we'll talk a little bit more about this next time, how many B, trade by the seat of their pants? All right, for those of you, I commend you that you're working on a plan. You're trying. Good. Trying is good. And I'll give you some ideas next time we get together about a plan as we start to get into 2019. So that's good. So if you have any other questions for today, one thing I'll just bring up, Thanksgiving. Once a year, we run a Thanksgiving holiday special. Basically what it is, could save 33% on all our on-demand classes now until the end of November. So once a year we do this. And so most of these classes are anywhere from $100 to $400. So whatever you buy, and usually a lot of people will buy 2, 3, 4 classes, whatever that number is, you get 33% off. Once a year we do it. We don't do it any other time. We've been doing this for, 7 years, 6 years, about 8 years, whatever. Want to take advantage of that. The nice thing is if you go to Sheridan Mentoring and click on this and you look, what's nice is all these classes that we've done, every one of them is annotated. I personally annotated them so you can see exactly every minute of the webinars, what am I covering ahead of time. So that's nice. Anyway, just want to let you know that. Well, folks, have a nice holiday. We will be back probably a couple of weeks. I'll send you, and we'll plow through more of this stuff. And I think next time we'll talk a little bit more about what should go into as you're trying to make your plan for 2019, an intentional plan, right? You should have a plan. Whether you're trying to make $1,000 a month, $10,000 a month, $2 a month, whatever it is. We'll talk about what goes into that. So, folks, have a wonderful day, and we will see you. Thanks.